What if I told you that the next market crash could be the best thing to happen to your portfolio? It sounds counterintuitive, but it's true. While most investors panic and sell during downturns, savvy investors see these moments as golden opportunities. In this video, we're going to explore why market crashes aren't as scary as you might think. You'll learn how understanding market patterns can transform you from a nervous investor into a confident one, ready to capitalize on every dip and downturn. Get ready to see market dips in a whole new light. It's like preparing for the thrilling drops on a financial roller coaster. Did you know that the stock market has been on an incredible journey since 1928? It's true. The average annual return has been a whopping 10.5%. But here's the thing. It's not all smooth sailing. The market is more like a roller coaster than a steady climb, and that's what we're going to explore today. Let's talk about market volatility. It's that stomach-dropping feeling you get when you check your portfolio and see a sea of red. Even in years where the market ends up, we see some significant dips along the way. Since 1980, we've seen an average intra-year drop of 14.2%. That means in a typical year, at some point, your investments might lose over 14% of their value. Put that into perspective. Say you've got $10,000 invested. A 14% drop would knock that down to $8,600. For many people, seeing their hard-earned money shrink like that is enough to make them want to sell everything. But understanding these patterns can be a game changer. If you know that these drops are normal, even expected, suddenly they're not so terrifying. It's like knowing that turbulence is a normal part of flying. Sure, it might still make you grip your armrest a little tighter, but you're not going to jump out of the plane, right? Now let's talk about the disconnect between long-term returns and short-term volatility. Remember that 10.5% annual return we mentioned earlier? That's the big picture. But zoom in and you'll see a lot of zigzags. It's like looking at a city skyline from far away versus walking the streets. From a distance, you see the overall upward trend, but up close, you'll notice all the little ups and downs. This disconnect is what trips up many investors. They focus on the day-to-day or week-to-week changes, losing sight of the long-term trajectory. It's like judging a whole movie based on a single scene. You might miss out on a great story if you walk out too soon. Understanding these patterns is crucial because it can completely transform how you approach investing. Instead of panicking during a dip, you might see it as a buying opportunity. Instead of selling at the first sign of trouble, you might hold steady knowing that historically, the market has always bounced back. Think about it like this. If you know that sales happen regularly at your favorite store, you don't freak out when things aren't on sale. You wait patiently, knowing a discount is coming. The same principle applies to investing. When you understand market patterns, you can make informed decisions rather than emotional ones. Now let's talk about something that might surprise you. Remember how we discussed market patterns and making informed decisions? Well, there's another crucial piece of the puzzle that can completely change your perspective on market crashes. Did you know that significant market drops happen more often than you think? Here's the eye-opening truth. Market corrections, which are drops of 10% or more, occur with surprising regularity. In fact, since 1980, we've seen an average intra-year drop of 14.2%. That means in any given year, you can expect your investments to take a temporary nosedive at some point. But here's the key. Understanding the difference between these intra-year drops and year-end results. While we see these dips throughout the year, the market has still managed to end up positive in 32 out of the last 43 years. Since 1980, we've experienced a 10% market correction, about once every 2 years on average. And those bigger, scarier 20% drops? They tend to show up roughly every 7 years. Think of it this way. Imagine you're on a road trip. You know you'll hit some bumps and maybe even a few potholes along the way. But does that stop you from reaching your destination? Of course not. You expect these minor setbacks and keep moving forward. Now let's consider how this affects retirement planning. Over a 30-year retirement, you can expect to experience 8 to 10 significant corrections. Imagine you're 65, living off your investments, and suddenly the market takes a 15% dive. Without understanding these patterns, you might be tempted to sell everything in a panic. But armed with this information, you can take a deep breath and remember, this too shall pass. The real magic happens when you start to see these corrections not as threats, but as opportunities. Remember our analogy about sales at your favorite store? Well, market corrections are like surprise sales in the investing world. If you're prepared and have some cash on hand, you can actually use these dips to buy quality investments at a discount. Understanding the frequency of market corrections gives you a powerful perspective as an investor. When you know that these drops are a normal, even expected part of investing, they become less scary. Instead of seeing each dip as a potential disaster, you can view it as just another bump on the road to long-term growth. This knowledge empowers you to make informed decisions, stay calm during market turbulence, and potentially capitalize on opportunities that others might miss. Did you know that a $1 million retirement portfolio could experience 8 significant drops of $200,000 or more over 25 years? It's a startling reality that many retirees face. Let's explore what this roller coaster might look like and why staying the course can lead to surprising growth. Imagine retiring in 2000 with a cool $1 million. You're feeling great about your financial future, ready to enjoy the fruits of your labor. But suddenly, the market takes a nosedive and your portfolio shrinks to $800,000 or less. The emotional impact can be intense. Will you still be able to take that dream vacation? Help your grandkids with college? These worries can keep you up at night. As your portfolio grows, these drops can have an even bigger dollar impact. If your initial $1 million grows to $1.5 million, a 20% drop means losing $300 instead of $200. It's enough to make anyone's stomach churn. Consider Bob and Susan, who retired in 2000 with exactly $1 million. They watched their portfolio plummet by 30% during the dot-com crash and again in 2008. Each time, they were tempted to sell everything and hide their money under a mattress. But they didn't. So what happened to their portfolio? If they had invested in a simple S&P 500 index fund and reinvested their dividends, their $1 million would have grown to over $4 million by 2023, even after accounting for yearly withdrawals. That's right, their portfolio more than quadrupled despite experiencing some of the worst market crashes in recent history. Reinvesting dividends played a crucial role in this growth. By automatically buying more shares when prices were low, they were able to capitalize on market recoveries and compound their returns over time. The key takeaway? Those nerve-wracking drops were actually part of the journey to growing their wealth. It's like planting a tree. You might see it bend in the wind, maybe even lose some leaves, but over time, it grows stronger and taller. So why do so many investors still end up losing money if staying invested can lead to such impressive growth? The answer lies in our emotional responses to market volatility and the decisions we make during turbulent times. It's human nature to want to protect what we have, but sometimes that instinct can lead us astray in the world of investing. Remember, market corrections are like surprise sales. While they can be unsettling, especially for retirees watching their nest egg, they also present opportunities for long-term growth. The challenge is maintaining perspective and staying calm when your portfolio takes a dip. It's not just about the numbers on a page. It's about understanding the bigger picture of market cycles and having faith in the power of long-term investing. Prepare to be shocked even when investment funds perform exceptionally well. Many investors still lose money. This mind-boggling paradox is a harsh reality in the world of finance, and understanding it could revolutionize your investment strategy. Picture this. You've backed the winning horse, but somehow leave the racetrack empty-handed. That's exactly what happens to many investors, even when they choose successful funds. This phenomenon, known as the gap between investor returns and investment returns, is alarmingly common. The numbers are staggering. A 2022 Dalbar study revealed that over the past 30 years, the average equity mutual fund investor underperformed the S&P 500 by 4.5% annually. This gap can cause investors hundreds of thousands of dollars over their lifetime. To understand why, let's explore the Peter Lynch paradox. Lynch, a legendary fund manager, achieved incredible returns at Fidelity's Magellan Fund. However, he noticed something perplexing. Despite the fund's stellar performance, many individual investors lost money. Fund managers like Lynch calculate their returns based on the fund's overall performance, assuming a buy and hold strategy. But individual investors often buy and sell at different times, impacting their personal returns. The culprit? Our own psychology. We're hardwired with biases that can derail our investment decisions. Loss aversion, for instance, makes us feel the pain of losses more acutely than the pleasure of gains. This often leads to selling during market downturns and buying back after the market recovers, missing out on the upswing. Recency bias is another factor. We tend to give more weight to recent events and extrapolate them into the future. When the market's booming, we might invest heavily, thinking the good times will last forever. During downturns, we might panic and sell, believing things will only worsen. The long-term impact is profound. Over the 30-year period ending in 2021, the S&P 500 returned an average of 10.65% annually. However, the average equity fund investor earned just 7.13% annually. This 3.52% gap, compounded over 3 decades, is a difference between turning $100,000 into $1,904,738 or just $767,805. So how can you avoid this trap? Start by recognizing that market volatility is normal and expected. Train yourself to see market dips as opportunities rather than disasters. One practical tip is to automate your investments, setting up regular contributions regardless of market conditions. This can help overcome the urge to time the market based on emotions. Remember, successfully investing isn't just about choosing the right investments. It's about having the discipline to stick with your strategy through ups and downs. By shifting your focus from short-term fluctuations to long-term growth, you can harness the power of compound returns and potentially avoid the fate of underperforming investors. Can you really time the market? It's a tantalizing idea, but here's a shocking truth. Even professional investors struggle to consistently outperform the market. So if the pros can't do it reliably, what chance do we have? Let's paint a picture. Imagine you're standing on the sidelines, cash in hand, waiting for that big market dip everyone's been predicting. You've heard the warnings, read the doom and gloom headlines, and you're convinced that any day now the market will take a nosedive. So you wait and wait and wait some more. But here's what's really happening while you're waiting. The market is quietly climbing higher. Over the past 10 years, the stock market has hit approximately 300 all-time highs. That's right, while you've been waiting for a crash, the market has been steadily marching upward, reaching new peaks about every 14 trading days on average. Now you might be thinking, okay, but what about those big crashes we hear about? Fair question. Significant market drops do happen. Since 1980, we've seen an average intra-year drop of 14.2%. That sounds scary, right? But despite these drops, the market has still managed to grow over time. Let's break it down. Say you decided to wait out the volatility back in 2013, convinced the crash was coming. You would have missed out on 9 years of growth, including dozens of all-time highs. By trying to time the market, you could have left thousands, if not hundreds of thousands, of dollars on the table. This is where the concept of time in the market versus timing the market comes into play. Studies have shown that staying invested, even through the ups and downs, tends to yield better results than trying to jump in and out at the right times. Consider this eye-opening fact. If you had invested $10,000 in the S&P 500 at the beginning of 1980 and stayed fully invested, your portfolio would have grown to over $700,000 by the end of 2020. But if you missed just the 10 best market days over that entire year period, your portfolio would only be worth about half that amount. That's the power of staying invested. So, what's the alternative to trying to time the market? The key is to adopt a strategy of regular investing regardless of market conditions. This approach, called dollar cost averaging, means you're buying into the market consistently, whether it's up, down, or sideways. Remember, the goal isn't to avoid every market dip or crash. The goal is to build wealth over the long term. And historically, the stock market has been one of the most powerful wealth-building tools available to individual investors. Ever wondered how to turn those nail-biting market swings into a wealth-building advantage? It's possible, and it all starts with building a crash-resistant portfolio. The secret isn't just picking the right stocks. It's about diversification. Think of diversification like building a house. You wouldn't use just one material, right? You'd use a mix to make it strong and stable. That's what diversification does for your investments. It spreads your money across different types of assets to create a more stable foundation. A well-diversified portfolio typically includes a mix of stocks, bonds, and other assets. Each reacts differently to market conditions, helping smooth out the ups and downs. For example, a portfolio with 60% globally diversified stocks and 40% bonds would have returned an impressive 8.72% annually from 1990 to 2019. That's close to the S&P 500's return of nearly 10%, but with less volatility. You might wonder, why include bonds? Aren't they just for retirees? Actually, bonds play a crucial role in stabilizing your portfolio during market turbulence. They've been positive in 43 out of the past 48 years, despite an average inter-year drop of about 3.5%. Here's where it gets interesting. With a diversified portfolio, you can use market volatility to your advantage through rebalancing. Let's break it down. 1. Start with a 60-40 split between stocks and bonds. 2. When stocks drop, your portfolio might shift to 55-45. 3. Sell some bonds and buy more stocks at a discount. 4. When the market recovers, do the opposite. It's like being the only person with an umbrella when it rains. Everyone else gets soaked, but you stay dry. But how does this hold up in real-world crashes? During the 2008 financial crisis, while the S&P 500 plummeted by over 37%, a balanced portfolio would have limited losses to around 20%. That's still a drop, but much easier to recover from. Remember, building a crash-resistant portfolio isn't about avoiding all losses. It's about creating a setup that can withstand market turmoil without derailing your long-term financial goals. It's like wearing a seatbelt. It doesn't prevent accidents, but it sure makes them a lot less scary. So how do you determine the right asset allocation for your situation? Consider your age, risk tolerance, and financial goals. Younger investors might lean towards more stocks for growth, while those nearing retirement might prefer more bonds for stability. It's always wise to consult with a financial advisor to tailor your strategy to your unique circumstances. The key is understanding that a diversified, balanced portfolio isn't just a safety net. It's a powerful tool for long-term wealth building. By embracing market volatility instead of fearing it, you can turn those nerve-wracking swings into opportunities for growth. What if I told you the biggest threat to your investment success isn't market volatility, but something much closer to home? It's you. Your own psychology can be your worst enemy when it comes to investing. Let's explore why and how to combat it. A study by Dalbar found that the average investor underperformed the S&P 500 by 4.35% annually over 20 years. This massive gap isn't due to lack of information or poor investment options. It's our cognitive biases at work. Consider the last market downturn. Did you feel an urge to sell everything? That's loss aversion. We feel losses more intensely than gains. Those who sold during downturns often locked in losses and missed the recovery, like getting off a roller coaster at its lowest point. When markets soar, fear of missing out, FOMO, kicks in. Investors pile into hot stocks, often buying at peak prices. Remember the dot-com bubble or the 2017 cryptocurrency craze? Many bought high and sold low, driven by emotion. To overcome these psychological traps, Develop a disciplined investment approach. Create a solid plan based on your goals and risk tolerance. Then stick to it regardless of market conditions. It's like planning a long road trip. You prepare for the journey, including potential bumps along the way. Here's a practical exercise to combat emotional decision-making. Before making any investment move, write down your reasons. Is it based on your long-term strategy or a knee-jerk reaction to market news? This simple act can help you recognize and counteract cognitive biases in real time. Automate your investments through dollar-cost averaging. By investing a fixed amount regularly, you take emotion out of the equation. It's like putting your investing on autopilot, potentially lowering your average cost over time. Educate yourself about market history and patterns. Remember how we talked about the average intra-year drop of 14.2% since 1980? Understanding that these dips are normal makes them less scary. It's like knowing turbulence is a part of flying. You might grip your armrest, but you won't jump out of the plane. By managing our psychology, we can transform from reactive, emotional investors into proactive, rational decision makers. It's not about eliminating emotions entirely. That's impossible. It's about recognizing our biases and developing strategies to counteract them. Remember, the most successful investors aren't necessarily the smartest, but those who can control their emotions and stick to their plan. Market crashes are natural parts of investing, not financial disasters. By understanding patterns and managing emotions, we can turn downturns into growth opportunities. Remember, even with an average 14.2% intra-year drop since 1980, markets have consistently rebounded. As Kevin Lum noted, you may face 8 to 10 painful corrections in a 30-year retirement. Now you can see these as chances to buy quality investments at a discount. Take a moment to assess your own investment strategy. Are you prepared for market volatility? Start building your crash-resistant portfolio today through diversification and disciplined investing. The key to long-term success isn't avoiding volatility. It's learning to thrive in it. Remember, the most successful investors don't fear market corrections. They embrace them as opportunities for growth.